Yes, good morning to you all. Welcome to my session. So, in our today's class, we are going to continue with our Unit 9, in which we are going to see about introduction, approaches to variance analysis, calculation of variances. Then, also, we are going to have a look onto limitations of variance analysis, then reporting to management. Now, coming towards the introduction part, what do you mean by your variance? In simple term or in cost accounting, variance means deviation. That means it is the difference between what was planned and what actually happened. So this particular deviation may relate to your cost, profit, sales, quantity, time, efficiency. So in simple terms, variance is nothing but standard performance minus actual performance. Now, next coming towards types of variances. So we have got different types of variances. That is, if you just have a look, we have two types of variances. The first is your favorable variance, and the second is your unfavorable variance. Unfavorable variance means adverse variance. Okay. Now, what do you mean by your favorable variance? In your favorable variance, basically, actual cost is less than standard cost, and actual profit is greater than standard profit. And also, we are going to indicate the efficiency, cost control, and better performance. Okay. Then, on the other hand, unfavorable variance is something where actual cost is greater than standard cost and actual profit is less than standard profit. Okay. And this indicates inefficiency. That means there is no proper control, poor control, or wastage of materials. So, unfavorable variance is also called your credit variance, and your adverse variance is also called debit variance. So, favorable variance is called credit variance, and the unfavorable variance is called your debit variance. Now, I'll just give you a small example. For example, your standard material cost is 10,000 and actual material cost is 9,200. Okay. So what is the variance? Variance is nothing but that we have seen standard minus actual. So 10,000 minus 9,200 gives you 800. For example, if the actual cost was 10,800, what will happen? 800 will be unfavorable. Okay, that means standard material cost is 10,000. Actual material cost is 10,800. So 10,000 minus 10,800 will give you minus 800. So since you are getting a negative value, this is nothing but this is your unfavorable variance or adverse variance. Okay. Basically, what does this variance analysis helps us? It helps us to control our cost. It helps us to improve efficiency in various to identify various problem areas, how to fix the responsibility, how to achieve your planned profit. Okay, for all these things, variance analysis is very important for the management. Okay, that means these variances act as warning signals to the organization. Okay, no doubt management, they focus only on significant unfavorable variance and they try to ignore areas where performance is as per standard. So this particular approach, we call it as management by exception. Why? Because management time is limited. Here, no need to interfere where performance is satisfactory, right? Yes. Now, next coming towards various approaches to your variance analysis. First, basically, variance analysis is done for your direct material, direct labor, overheads, and sales. First, we are going to have a look for direct material variance. Under this, you have material costs. Okay. So material cost variance is nothing but the difference between standard cost of material allowed or actual output and actual cost of materials that are used. And here the formula is given standard cost minus actual cost or price variance plus usage variance. Okay. Next, material price variance. Material price variance is the difference due to change in price. Okay, we are not taking into consideration the quantity. So difference that takes place due to change in price. That we call it as material price variance. So what is the formula for it? Actual quantity into standard price minus actual price. Okay. Next, material usage or quantity variance. This is nothing but this is difference due to excess or less consumption of material. Okay, the formula is material quantity variance is standard price into standard quantity minus actual quantity. Okay, so basically this material quantity variance, it tries to indicate wastage, poor quality, and inefficiency. Next is material mix variance. Okay. Now, what do you mean by material mix variance? Basically, this occurs when actual proportion of materials it differs from standard mix. Okay. When actual proportion of materials differs from standard mix. That time, material mix variance is taken into consideration. And also, it is important in your chemical industry, it is important in your cement industry, and also it is important in your work system. Okay. And then here we have various situations where this material mix variance is taken into consideration. First is total quantity, that is MMV equal to standard cost of standard mix minus standard cost of actual mix. And second situation is total actual mix divided by total revised standard mix into standard cost of revised mix minus standard cost of actual mix. Why are we using this? Because of substitution of material, non-availability of material, and because of price fluctuations. Okay. Next is material yield variance, MYV. What do you mean by material yield variance? This is the difference due to actual output that is being more or less than standard output from your given input. This particular variance we also call as scrap variance or loss yields. Okay, so material yield variance is nothing but standard rate into actual yield minus standard, where standard rate is nothing but standard cost of mix divided by net standard output. Okay, now next is direct labor variances. Here we have different types of variances, that is labor cost variance, labor rate of variance, total labor efficiency variance, labor efficiency variance, labor idle time variance, labor mix variance, or gang composition variance, then labor yield variance or labor efficiency sub variance. Let's have a look into first one, that is labor cost variance. Labor cost variance is nothing but it is the difference between your standard labor cost for actual output and actual labor cost. So the formula that is given is standard cost of labor minus actual cost of labor. Second, labor rate variance. Labor rate variance is nothing but difference due to change in wage rate. Okay. Difference due to change in wage rate. So the formula is actual time into standard rate minus actual rate. Okay. And total labor efficiency variance is nothing but this is difference due to time taken. Difference due to time taken. So this is basically used when we have normal idle time. Okay. So the total labor efficiency variance is nothing but standard rate into standard time minus actual time. And labor efficiency variance is equal to standard rate into standard time minus actual time work. And how do you calculate labor idle time variance? Labor idle time variance is calculated as loss due to abnormal idle time. Okay, we are not taking into consideration the normal rates. So why? Because there might be some power failure, there might be machine breakdown, there might be material shortage. Okay. Next is labor mix variance. Labor mix variance basically occurs when composition of labor force changes. Okay. So here, for example, more skilled workers we require instead of semi-skilled. Okay. So this is calculated similar to your material mix variance using standard cost comparison. Next is your labor yield variance. Okay, labor yield variance is nothing but the difference between actual output achieved and expected output from your actual hours that you have worked. So the formula for that is Labor yield variance equal to standard labor cost per unit into actual output minus standard output. So variance analysis is a powerful tool that you can see, which helps us to identify what went wrong, why it went wrong, who is responsible for this. Okay. And also it supports management by your perception, and it links accounting with your managerial decision making. Now, next coming towards your overhead variances. Now, next coming towards overhead variances. Overhead variance is nothing but this is the difference between your standard overhead cost that is allowed for your actual output and actual overhead cost that is incurred. So, in simple time, this shows whether overheads are overabsorbed or underabsorbed. Okay, and that is given over here is overhead cost variance is nothing but standard output into standard overhead rate minus actual overhead cost, or standard as for actual output into standard overhead rate per hour minus actual overhead cost. Coming towards your fixed overhead variance. Dates पिछले साल Sorry for little disturbance. So we were discussing about your overhead variance. So overhead variance is nothing but in simple term, it is a difference between your standard overhead cost that is allowed for your actual output and actual overhead cost that is being incurred. So what is the formula for that? Overhead cost variance is equal to standard output into standard overhead rate minus actual overhead cost, or standard hours per actual output into standard overhead rate per hour minus actual overhead cost. So, in simple terms, we can interpret that for favorable conditions, overheads are controlled efficiently, whereas for unfavorable, poor cost control or inefficiency. Okay, now coming towards classification of your overhead variance. Okay, so as we have seen, overhead variants are classified into fixed overhead and your variable overhead. Okay, so variable overhead is nothing but this change directly with your output. So therefore, only expenditure variance exists, not your volume variance. And variable overhead variance arise only due to the difference in spending, not your capacity. And the formula that is given for your overhead variance is equal to standard output into standard variable overhead rate minus actual variable overhead cost, or standard hours for actual output into standard variable overhead rate per hour minus actual variable overhead cost. Okay, so what are the reasons for the variable overhead variance? This basically happens because of increase in your power tariff. Okay, sometimes because of poor supervision, because of rise in indirect labor cost, or inefficient use of indirect materials. Okay, and coming towards your insights, I mean, in short, I'll just try to tell you. Since variable overheads just vary with your output, so basically management will try to focus on your cost control, efficiency in usage, and prevention of wastage. Next, coming towards your fixed overhead variance. Okay, so fixed overhead variance is nothing but this fixed overhead variance basically what comes under this your rent, your salaries, your depreciation. These do not change with output in the short run. However, this variance arises due to underutilization of capacity or over or under absorption of your fixed cost. Okay, so the formula for this is fixed overhead variance equal to standard output into standard fixed overhead rate minus actual fixed overhead, or standard hours for actual output into standard fixed overhead rate per hour minus actual fixed overheads. Okay. So basically, this fixed cost incurred as planned, lower production cost under absorption. This indicates there is capacity underutilization. So fixed variance helps management to evaluate your capacity usage, plan production levels, and control midterm cost. Okay, now coming towards your sales variance. Sales variance basically this refers to the difference between your actual performance and standard performance. Okay, because profit equal to sales minus cost. So here profit variance cannot be fully understood without your sales variance analysis. So what is the purpose of the sales variance analysis? This helps us to understand market performance. It tries to measure sales efficiency. It tries to identify your pricing and volume issues. Okay. And also it helps us to analyze profit relations. Okay. And we have different methods of your sales goals. First is your profit method, and the second is your sales value method. Okay, profit method. This method shows impact of sales on profit. So it is more useful for management decision making, and it focuses on contribution and profit. Okay. Um, Coming towards your sales value method. Okay. So under this method, sales variance are calculated based on sales value, not on profit. So less meaningful than profit method, but this is more useful for your sales department performance review. Okay, and what is the formula for it? Sales variance equal to actual sales value minus standard sales value. Okay. Now next coming towards variances in practice. Variance analysis is not merely about your formula that is fixed calculation. Okay. In practice, many organizations they use variances as a managerial control and decision making tool. So hence many companies they try to adopt different practical approaches to calculate and interpret variances. Under this, the first is your time period comparison. Under time period comparison, this method or this approach, actual performance is compared with performance of year to date or last 6 months, or full financial year, or same period of previous year. Okay. So in practical, instead of waiting till the end of the year, many companies they try to compare current performance with expected performance. And also, they try to revise expectations based on current trends. Okay, I'll give you a small example. For example, the annual budget profit is 10 crore. Okay, and the profit that is achieved in 6 months is 3 crore. Okay, that means this indicates there is a shortfall of 3 crores against expected 5 crores. So management must try to assess whether this deficit can be recovered or will these causes continue. Okay, so for the senior management, they analyze to decide dividend policy, cash requirement, production and sales push, cost cutting. So therefore, this approach makes variance analysis to look forward, not to look on the past that is not historical. Okay, next is focus on margin. Okay, this method we call it as gross margin update. In this method, instead of focusing only on selling price, companies will also focus on gross margin. And gross margin equal to selling price minus standard manufacturing cost. Why margin focus? Because selling prices are often market driven, and this is uncontrollable factor. And cost control, it directly impacts your profit. So managers, they evaluate on margin performance, not taking consideration only price alone. Okay. So this particular approach helps the management to help in your pricing decisions. It helps to encourage cost control and also it tries to link various analysis directly to profitability. Next is your evaluation standard. In this evaluation standard, to make it more meaningful, standards of comparisons must be clearly defined. Okay. So the first is predetermined standard. Under this predetermined standard, these are also known as budgets. These are pre-planned, well coordinated, and also they are based on forecast and estimate. So this is primarily used as your benchmarks. And what are the advantages of it? This is best for controlling, and also it enables your responsibility accounting. If budgets are poorly prepared, variance analysis becomes so. What is the limitation of this? Analysis. If budgets are poorly prepared, variance analysis becomes more misleading. Coming towards your historical standard. Historical standard are based on your past actual performance or last month or last year data. Okay, that means just trying to compare your current month production with same month last year. Okay, so this is more useful or more helpful when budgets are unavailable or when your operations are stable. But it may also encourage your inefficiency. Now, next coming towards your external standards. External standards are nothing but this acts as your benchmarks. So performance is basically compared with other branches, other responsibility centers, and also best performing companies in the industry. Therefore, this is called benchmarking. So here we are just trying to, for example, we are just trying to compare the productivity of Hyderabad plant with Bangalore plant. Okay, or else comparing company performance with industry standards or industry leaders. Okay, so this particular approach will try to encourage best practice. It also helps us to promote competitiveness and also it helps in your strategic improvement. Now, next is your full cost system and variance analysis. So, under full cost system, both your fixed and variable costs are included in your production cost. Sometimes it becomes a problem for us to separate fixed and variable costs. And also, variance analysis becomes complex. Okay. So here the company is to try to identify variances by comparing actual production volume with standard production volume. And also it helps to analyze overall under absorption of cost. And what is one of the limitations? This is one of the less effective for your short-term control. At the same time, it is more suitable for long-term pricing decisions. Okay. Now, next coming towards what are the limitations of your variance analysis. As we already told you, variance analysis is a powerful tool where it has several practical limitations. Okay, first of all, it tells us where and not to be. Okay, so variance analysis helps to identify area of deviation, but not What are the reasons behind deviation? And also, further investigation is required. Second, it is a time consuming. That means variance reports are prepared, event, and also corrective action may be delayed. There will be no future orientation. So, variance analysis is backward looking. It does not predict your future performance. Okay? Fourth, significance is not always clear. That means small variances may be ignored and large variances may be uncontrollable. Next, aggregated data problem is there. Data may hide critical issues and delayed causes may be overlooked. Sometimes information will be overloaded. That means too many variances create confusion. So there might be chances that manager may ignore reports. And there is a lack of understanding. That means many managers they do not fully understand the technical issues. So this reduces your practical usefulness. Okay? So variance analysis is only useful when you have combined with investigation and it is being supported by your management action and also when it is interpreted intelligently. Okay. Next is reporting to management. Basically, this reporting management is a formal system through which we will be getting relevant information. Okay, this information is communicated to different levels of management at regular intervals of time because reporting is a backbone of planning and control. So the responsibility of this reporting are based on your cost center, your profit center, and your responsibility center. Okay, because managers they try to evaluate only for cost and revenues which are under their control. And the flow of information is like, for example, detailed report. Detailed report is being presented by a lower management. Summarized report is being presented by a top management. For example, I'm just trying to present a detailed cost report. So this report is presented by floor supervisor, you can say. When I'm preparing summarized report, this is prepared by your managing director. Okay. So basically, a report is nothing but a report may involve what are the narration of facts, is a kind of critical review, periodic data submission, special information on request. This is how you're going to define a report. Okay. Once again, I'll repeat a report may be it involves your narration of facts, critical review, periodic data submission, and special information or request. And what are the different types of reports? You have different types of reports. Either the report may be oral or written, or routine or special report. Okay, coming towards the objectives of reporting. First objective in simple words, it provides you regular information for planning and control. Second is it is to secure understanding and approval of the judgment by the people engaged in various aspects of works of enterprise. That means here we are trying to secure understanding and cooperation of employees. Third, to determine the degree of performance and responsibility for which the concerned responsibility center manager is solely responsible. So, in simple words, we are trying to measure performance of responsibility center. And the last objective is a try to facilitate corrective actions. Okay. Now, what are the essentials of good reporting system? System okay, be proper and form. That means suitable layout should be there, chart should be there, table should be there. And also, finally, it should be presented. Prompt reporting. Third, systematic flow. That means right information to right authority. Fourth, it should be flexible. Okay, that means it should be adaptable to user needs. Okay. Fifth is facilitation of evaluation. That means it should highlight deviations. Okay. And the last is it should be economical. That means benefits towards cost. Benefit. Are the benefits greater than cost? Next, what are the different modes of reporting? Different modes of reporting. You have written reports, you have graphic reports, you have oral reports. Coming towards your written reports, written statements, that is formal financial statements. Okay, second is your statistical tables. Third is your ratio analysis. Next is your graphic reports. That means it should include your charts, your diagrams, and graphs. Why? Because it is best for quick understanding of your trends. Next is your oral report. Oral report is being basically presented for your meetings or conferences. And also it is useful but less reliable than your written reports. What are the basic requisites of a good report? Your report should be prompt. It should be in clear form and content. It should be comprehensive. Should it should be simple. It should be controllability, appropriateness, cost effectiveness, and accuracy. Next is classification of the reports. Classification of reports is basically done as per shift, period, and function. When we are speaking about object, we have external report and internal report. Speaking about a period, we have routine report and special report. And as per function is operating report, financial report. Okay. Apart from this, we have some special reports. We have some special reports which are being prepared on specific requests, basically for investigation and also with some recommendations. Like, for example, you will be having a competitive analysis report. You will be having your product selection report or price change report. Okay. Finance report, operating report. In this operating report, you have two types of reports. The first is your control report, and the second is your information report. Control report is based on budget and standard, whereas information report is used for planning and policy. Also have financial report. Financial report is prepared based on your balance sheet, which is called static report. And the next is your dynamic report that goes on with your cash flow and okay. Next is usefulness of reporting to management. The reporting system will try to help management with strengths of operations. It helps us to identify weakness. It plans future activities. It helps us to formulate your policies and order, and also to monitor your performance and also to take corrective actions. Okay, so for these types of things, we go for reporting. So, in conclusion, in this cost and management accounting organization, they always try to prepare standards on budget and efforts. So these standards show what the expected cost is, sales or cost after the actual work is done. The results are compared with the standards. So the difference between these actual figures and the standard figures, we call it as variance. So variance is nothing but deviation, right? So in simple words, it helps us to tell us how much the actual performance differs from what was planned. And also in this, we have seen different types of variance, that is favorable variance, unfavorable variance. Then we have seen the role of variance in management reporting, where it helps us to highlight problem areas where performance is not as per plan, and also management will try to take corrective action. It also helps us to assist in performance evaluation of department and employees, and also it helps us to improve your efficiency and cost control. Okay, so with this we have completed your ninth unit. Now next, coming towards your 10th unit. In your 10th unit, we are going to see about performance evaluation. What are the multiple performance measures, performance evaluation criteria, evaluating the economic performance of an entity, performance reports, and then the summary of it. Okay. So, in this particular unit, we are going to deal with performance measurement and also performance evaluation in an organization, especially when the organization is divided into different divisions. And also, it helps us to discuss performance reports, which are used by management to review how well different divisions are being performed. So, in simple word, performance measurements means measuring how well a division or a manager is achieving its objective. So, basically, it tries to focus on your profit, efficiency, productivity, okay, market position, and long-term growth. So, performance evaluation, they try to use this management to judge the effectiveness of divisional managers. Okay? And what are the objectives of your performance measurement system? The first is to provide information for economic decision. Second, to facilitate control of division operations. And third, to motivate managers to achieve high performance. And fourth is to evaluate the performance of divisional managers. Okay. Next, divisional structure and decentralization. Already we have seen this. Decentralization means authority is being delegated to divisional managers, and diversification is something handling different products, services, or markets. So each division it has got an autonomous responsibility center. That means they have its own revenue and cost center. It is responsible for its own profit, and also the divisional heads are authorized to make decisions within their division. So, however, the final responsibility lies with top management on to. Now it's coming towards your multiple performance measures. Okay. Here, the divisionalization basically it refers to dividing an organization into separate profit-oriented division, which are based on your product, service, areas, or process. So here, each division is treated as a profit center. Okay. What is the purpose of divisionality? Divisionalization. They are accountable for profit. That means each division is responsible for generating its own profit, and also managers are accountable for their division. Next, interdivision comparison. That means the performance of different divisions are being compared. And also, it helps us to identify best and worst performing divisions. Okay, next, improve the strategy and planning. Here, divisional performance data helps in strategic planning, operational planning, and resource allocation. As well as there is a kind of a healthy competition between among different divisional managers, and also it helps us to improve efficiency and innovation. Okay. Then next we have what are the key result areas of GEs? 8 key result areas of GEs. That is general electric, which is there in USA. So, what are the key areas of GE? The first is your profitability. Second is your productivity. Okay. In profitability, we are going to measure your measure using your residual income. Still a perform financial performance indicator. Okay. Second is your productivity. That means output in relation to your input, where we try to measure the efficiency. Third, we are going to detect about market position, where it is measured by your market share. And also, it helps us to indicate competitive strength. Fourth is your product leadership, superiority of products over competitors, and also innovation and development status. Next is your personal development, where training effectiveness is taken into consideration, and also employee growth and satisfaction is being considered. Next is your employee attitude, where we are trying to measure those surveys. So, job satisfaction, pay, promotions. Next, public responsibility, where we are going to comply with laws, that is, rules and regulations, and also ethical business practices. Next, there should be a balance between short and long term goal. That means this will try to ensure short term profit that does not damage your long term. Okay. So when many performance measures are being used, managers may only they try to trade off one measure that is against another. So to avoid this, all dimensions should be given equal importance. And also management must ensure long-term profitability is being protected. Apart from this, we have investment in intensity, that is asset turn. So investment intensity is nothing but it tries to measure the relationship between your sales revenue and investment in assets used to generate those sales. And what are the strengths of it? It tries to show at asset utilization, and also it tries to show us the importance of return on assets. Okay. And what is the weakness of it? Asset utilization is only a means, but not the final objective. So it does not change significantly over time. Next is your market share. Market share is nothing but this is the percentage of total market sales that are captured by a company. That means we are trying to measure in rupees or in units. So basically, this is based on your product category or your market segment. And what are the benefits of it? It's strongly related to your profitability, factor, and also it is easy to understand and measure. And the weaknesses, it does not directly measure your quality. Okay, sometimes it may be complex in nature. Third is relative product quality. Relative product quality is try to compare a firm's product quality with competitors based on reliability, based on your repair cost and effectiveness in use. And what are the strengths of it? It is closely related to your profitability and it is easily understood in social media. And the weaknesses, it is difficult to measure precisely. And quality is a means to profitability but not an end. So, in simple words, divisions are created just to improve control and accountability. And profit alone is not enough to measure your performance. So, multiple performance measures this tries to ensure your balanced evaluation and long term success is more important than short term profit. Okay, so just keep it in mind. Long term success is more important than short term profit. Next, performance evaluation criteria. Coming towards your performance evaluation criteria, this refers to the standard. This refers to the standard and method that is used to judge how well a division and its managers perform. So, for a fair and accurate evaluation, three elements are being computed. The first is your cost. Okay. Second is your revenue. And the third is capital that is being employed. Okay. So these elements may be controllable or traceable, and their correct identification is very important. So, any mistake that is made in their computation will lead us to wrong evaluation of divisional performance. Okay, and in practice, it is somewhat difficult to identify which costs are controllable by a divisional manager and also to decide which revenues are influenced by a particular division and also how to allocate capital employed fairly among divisions. This is not clearly identified. So therefore, before you design an evaluation system, an in-depth study is required. Okay. Now, what are the responsibilities of management? The central management or top management, they must ensure your accountability, goal alignment, fair allocation of objectives, neutral evaluation, right? So these things they have to keep into consideration. Now, next is your balanced scorecard. Balanced scorecard, this is a comprehensive performance measurement that converts your strategy into action. And also, it uses both financial and non financial measures. It also focuses on long term value creation. So, this the concept of your balance scorecard is developed by Kaplan and Norton, where they try to address the limitation of traditional financial shares. Okay, what is the necessity of this balance scorecard? Why it is needed? Basically, it is needed to measure financial performance that reflect your past performance. They are inadequate for information age organization. And also, modern business, they are totally dependent on customers, employees, technology, innovation. So this balance scorecard, it integrates your tangible as well as intangible assets. Okay. And what are the key features? of your balanced scorecard. The first is it tries to translate your vision and strategy into objectives. It tries to link your short term actions into long term goals. It helps in strategic planning and control, and also it acts as a management tool, not merely a measurement tool. Next, four legs of your balanced scorecard. Number one is learning and growth. Second, business process. Third, customer perspective. Fourth is financial data. So, learning and growth perspective, that means employee training, your knowledge management, skill development, and innovation capability. That means here they are trying to focus on future readiness and competitive advantage. Second is internal business perspective. So here, inefficiency of production, process improvement, there must be reduction in delays and bottlenecks. So here they are trying to focus on operational excellence. Third is customer perspective. That means customer satisfaction is taken into consideration, price, delivery, loyalty, and feedback. So in this customer perspective, we are going to focus on market success. And the last is your financial data, that is financial perspective. So towards this sales growth, about profitability, about cost control, and return on investment. So here we are focusing on the financial health of the organization. So these four perspectives, they together represent the vision and strategy of the organization. Next is contribution towards margin approach. And this profit margin is nothing but profit sales by profit sales profit. So what are the strengths of it? It is sensitive to changes in revenue and cost, major determinant of return on asset, and also it encourages cost control and revenue planning. And what is the weakness of it? It tries to ignore the capital that is employed. Sometimes it may lead to wrong resource allocation, and it is affected by accounting limitations. So divisional profitability can be measured using net profit, that is either before or after tax, and operating profit. Okay. So net profit may be distorted due to your sales of assets or abnormal gains or losses. Okay. And operating profit, this is the profit that is earned from core business activities. Okay. So higher operating profit indicates better operational performance. Next, divisional margin statement. So this statement emphasizes cost controllability and allocation. Okay, where we have sales, where okay, that means sales, less variable sales, less controllable divisional overheads. That gives you controlled profit. From controlled profit, again, you are subtracting fixed non-controllable divisional heads. That gives you contribution margin. From this, again, you are deducting your allocation of for fixed expenses. Then you'll be getting net before a net profit before tax. From this, you are deducting tax. Then you will be getting net profit after tax. Okay, so the importance of your contribution margin approaches, it tries to separate your controllable as well as uncontrollable costs, and also fair evaluation for your divisional managers. And also it helps your management in decision making, and it highlights real contribution of each division. Performance evaluation must be fair and objective. It should be controllable factor. That means you should judge. I mean, managers should judge this. And financial, non-financial measures are equally important. And balanced scorecard, it tries to ensure long-term success. Contribution margin gives a realistic picture of divisional profitability. So with this, I'll just wind up my today's class. In tomorrow's class, we'll continue with our return on investment. Okay. So thank you all for attending my session. Thank you once again.